Good evening and welcome to this class. This is ACC 102, Introduction to Financial Accounting. In our last discussion, we talked about receipts and expenditure accounts, and we took time to explain what receipt and expenditure account is. We said it's an account prepared by a non-governmental organization, which is synonymous with cash book that is being prepared by a profit organization. In the receipts and expenditure account, we said it focused mainly on all cash inflows and all cash outflows. This means irrespective of the period for which the cash was meant, provided it has entered in the organization, the receipt and expenditure account will capture it. And provided it has gone out of the organization, the receipt and expenditure will capture it. Now, we looked at the preparation formats where we highlighted 4 steps, 6 steps that must be followed for the preparation. And after which we looked at some examples. I think we handled up to 2 or 3 examples in the class. Now, we are doing a similar topic, which is the topic for today, and the topic is income and expenditure accounts. The note has been given, and I am sure by now you almost have finished copying it. Take note that you are going to present the notes one after the other, and evidence to show that you have actually copied the notes. In income and expenditure accounts, one will be asking, what is now the difference between these income and expenditure accounts and receipts and payment accounts? We say income and expenditure accounts is a nominal account prepared by the same non-trading consigns, that is a non-governmental organization, at the end of the accounting period, matching their revenues with expenses. And the essence is to determine whether they had surplus within that period or whether they had deficits within the period. Furthermore, we say this an account that states that all the expenses must be debited and all the income must be credited. Remember that in the receipts and payments account, the reverse is the case. In this case, while we debit expenses, in the receipt and payment account, we debit inflows. In this case, while we credit inflows, in the receipt and payment account, we credit what? Expenses. So, what you will understand about this is the posting format now is the reverse of the income, receipts and expenditure. The definition says the essence is to know whether there is surplus or deficit. Unlike the income and expenditure, we are not looking for surplus or deficit. We are only interested in the balance we are having. Now, features of income and expenditure accounts. What are the things that you will see for you to say that this is an income and expenditure account? 1, the revenue nature. Income and expenditure account is a nominal account which records transactions and events of a revenue nature. All the expenses and losses are debited and all the income and gains are credited. Remember, when we talk about revenue, you are more or less referring to turnover if it is a profit consign. So whatever that is being sold to increase the company's revenue is what the income and expenditure account is looking at. Now, it is not asking you whether these sales came in immediately as cash or whether it came in as what? Credit. This will take us to the second feature, which looks at the accrual basis of recording it. If it is in form of credit sales, receipt and expenditure will tell you it is not necessary because there is no cash movement. But income and expenditure account will consider it to be necessary because it has recognized what has happened as revenue, irrespective of whether payment has been made or not. That's the second feature. It is prepared based on accrual basis of accounting records. Now, the third one, or the third feature, is the current period. Income and expenditure account records only periods income and expenses, whether those income and expenses are paid or not. Another feature is adjustments. When you are preparing an income and expenditure account, there are some adjustments that are necessary to be made before you can fix some figures. Take for instance, you are owing a rent. You are paying for a particular office space 100 naira per annum. Now you are only owing that of last year, which is 100 naira, and in the current year you are also meant to pay 100 naira. If you decide to pay in this year, knowing fully well that you are paying last year, you decide to pay 200 naira this year, or let us take for instance, you decide to pay 250 naira, and in your 250 naira, you are taking 100 naira to be for last year, you are taking 100 naira to be for this year, and you are taking the last 50 naira to be for next year. It means you have paid your arrears and you also made some prepayments for the future. So that for the future is not yet due. Income and expenditure will only tell you to pick the one that is meant for this year and report on it. So if you are reporting, if you have paid for last year and you have paid for next year, you are going to subtract the figure that is meant for last year, remove it, subtract the one that is meant for this next year, remove it, and then capture only that which represents this particular year. So when you are doing that, questions will come in this way. For the current year, 250,000 naira was paid as rent. However, 100 naira belongs to last year and 50 naira was a prepayment for next year. You are now expected to carry out adjustments. When you are carrying out that adjustment, what you are doing in that adjustment is you are removing that for last year and you are removing that for next year, and you are bringing out that which only belongs to this year for your income and expenditure. But remember, if we are talking about receipts and payments, Receipt and payment will tell you both that of last year, that of this year, and the 50 naira for next year, which you have paid in this year, that you should report all of them in this year because the money actually left to your account this year. So you can see that these are some of the things you will see that will make you know that this is a receipt and payment account and this is income and expenditure accounts. The next section is the difference, which in my explanation I have been always using each of the features to differentiate that, but this section now looked at purely the difference between receipt and payment accounts and income and expenditure account. We have 4 differences there, which all of them still revolves around the explanation. The next one is the steps in preparation of income and expenditure accounts. When we talk about the steps, it means when questions are given to you, where do you start from to prepare these accounts? Step 1 says all the revenue receipts are credited to the income side of the income and expenditure accounts. Adjustments related to the accounting year are to be made where amounts relating to the preceding and succeeding year are excluded, and the amount relating to the current year yet not received are included. This is the first step, that you should credit all your words, income, and make necessary adjustments. Step 2, all revenue expenditure are debited to the income and expenditure accounts with due adjustments from the additional information provided relating to the amounts for the amount received in advance and those outstanding. The step 2 is simply telling you debit all your expenditures with the necessary adjustments. Now, step 3 says record all the non-cash expenditure and gains to determine the surplus to deficit of the current year, such as there are some non-cash expenditure that are expected. These non-cash expenditures includes depreciation of fixed assets, provision for doubtful debts if required, then profit or loss on sales of fixed assets. Now, when we talk about income and expenditure, somebody will be asking, what is now the difference between this income and expenditure and profit and loss accounts? Remember, income and expenditure purely is for non-profit making concern. So because they are not into the business to make profits, they are only there to render humanitarian service. It will now be wrong to say that at the end of the year, this motherless babies home made a profit of 200,000. If they are not there to make profit, then they are not meant to report whatever they have as profit. Rather, for non-governmental organizations, we say they are reporting what? Surplus, or they are reporting deficits. So income and expenditure is more or less profit and loss account for a profit-making organization. But for a non-profit making organization, it's called income and expenditure. Now, the next section looks at the format for the preparation. When you look at 2.5, you will see the format expected to be followed when you are preparing an income and expenditure account. The format starts with first the name of the organization, which you already have, income and expenditure accounts for the year ended, if the accounting period of the organization is 31st December, you say for the year ended 31st December 20 and so. Then, like we explained in the steps, expenditure is on the left side, income is on the right side. So on the left side, you go through your questions and identify all those items that represents an expenditure item, such as salary. You do your adjustment if there are some outstandings and advance, such as rents, insurance premium, audit fees, printing and stationaries, telephone expenses, repairs, depreciation of fixed assets, and all whatnot. So you look at them and itemize them at the left side. And on the right side, you look at your revenues, your revenue items, which is it can be subscriptions, it can be entrance fee, it can be donation, sale of newspaper, renting of hall, sundry receipts, all those channels and means through which you get a revenue. You identify them and then do necessary adjustments and record them on the income side. If the expenditure side is higher than the income side, it means you are going to be running into deficits. You now put the value at which the expenses is higher than the income. That value becomes a deficit value. By the time you now add it up, the two accounts will balance. If the income is higher than the expenditure amounts, whatever value the income is higher than the expenditure, you put it as surplus. By the time you put it as surplus and then sum up, the expenditure will balance with the income. We are going to look at a practical example in the next video. Thank you.